Most retirees assume their 2025 taxes will look similar to last year's, but that's no longer a safe bet. A new rule is changing how deductions work, and for some, it could mean paying thousands less in taxes. Now, I want to walk through a case study of a couple who ran the numbers early, and the difference I think might catch you off guard. In this video, let's break it down so you know exactly what's changing and how to spot if it affects you so that you can plan ahead and walk into tax season knowing you're not leaving a tip for the IRS. Okay, so I want to set up some assumptions here before we begin to look at the tax outcomes. John is still working. We'll say they're both age 62. Sarah, not working, currently retired. Congratulations, Sarah. But she has taken this year, by the end of the year, $60,000 in IRA distributions, and she decided to take her Social Security benefit early, which will be about $18,000 for the year. There's some taxable interest and qualified dividends as well, but this is the bulk of their income or taxable income picture. Now, Schedule A is the itemized deduction. They have $8,000 in mortgage interest that they can use as a deduction. As far as the state income tax piece, let's say that they made $4,500 worth of payments in the year. And on the property tax side, this number is going to feel big, but they have $14,000 in real estate or property taxes. Why is that? Sarah's father passed away, and they had a second home up north that they've elected to keep for some time. It's paid off, but there's property taxes there in addition to the taxes on their primary residence. So, how does this shake out with the old tax law, and what's changing or new with the new tax law? Alrighty, so this is a breakdown of how their tax picture would have worked out under the old tax laws. So we can see an adjusted gross income of $199,000. You can look back at some of the different income sources we just looked at. They'd take the standard deduction of $30,000. Their itemized deductions did not exceed this, and we'll talk about why in just a moment. For a total taxable income of $169,000, a total tax of just under $27,000. Now, if we go through, they have some space up to the 22% bracket to perhaps consider Roth conversions. That would certainly be part of the conversation. We can see they're firmly in the 15% tax bracket for capital gains, which the $2,500 of qualified dividends would be taxed at. They're firmly under the estimated MAGI threshold for 2027, meaning we would estimate that they would have no IRMA. Their Part B premium would simply be the base, same with Part D. And their Social Security, up to 85% of it is taxable. Again, their combined income brings them well above that threshold. So the total actual taxable benefits, 85% of the 18,000, 15,300 would be taxable. Now, this is their Schedule A. We see state and local taxes. This is the key, $10,000. Well, if you recall, they had $4,500 in income taxes and $14,000 in real estate taxes. Well, why are they only getting $10,000? Well, it's because the SALT, state and local tax deduction, was limited to $10,000 per year. This is the critical shift starting in 2025 for folks married, filing jointly, making less than $500,000 a year in taxable income. This cap has increased to $40,000, which we'll look at in a moment. So just in your head, remember this figure here, total federal tax estimated just shy of $27,000. So staying on top of new tax laws is going to help you successfully answer question 20 in my free retirement readiness score quiz. It's linked in the description, 20 quick questions, and it's going to show you your score out of 100. No email required, and you'll see your score instantly. Go ahead and take that. So here we are in the new tax law for 2025. Exact same income figures, inputs, everything. Here's the key difference. We see the same adjusted gross income, but now instead of the $30,000 standard deduction, they can itemize and take a $38,500 deduction, which subsequently reduces their taxable income by $8,500, thereby reducing the amount subject to federal tax just shy of $27,000, decreased to just shy of $25,000, about $2,000 in tax savings. Everything is the same. Again, the same room to consider Roth conversions. We have the same 15% capital gains tax rate. We have the same Magi level, keeping them under the estimated first tier for IRMA. Again, 85% of Social Security is still taxable. No surprise there. What's the main difference? On Schedule A, we see the new tax law allowing the $8,500 above the old 10K threshold to flow through. Again, causing their itemized deductions to be $38,500. This is a significant planning opportunity for people who have high state taxes, and particularly people who have property taxes that are high. Maybe you have a first home, maybe a second home as well. This unlocks additional deduction opportunities, which, as we saw, leads this family who takes advantage of this to save over $2,000 in federal taxes. So you also just saw how taking advantage of the new tax law could save you thousands. But what if your advisor isn't talking about Roth conversions when they could potentially save you hundreds of thousands of dollars over time? So watch this next video where I walk through a real $1.2 million case study showing exactly how smart timing on Roth conversions could significantly lower your tax bill and leave you with more in retirement.